I have graded now, Andy, over 100,000 natural resource portfolios. And grading those portfolios has given me tremendous insight into the few things that speculators get right and the plethora of things that speculators get wrong. But most of what they get wrong comes down to three things. They aren't contrarian, which is to say they wait till a sector is in favor and hence expensive before they buy it. They need the price action to justify the narrative. The second is related to that. They're fad chasers. Maybe I'm saying the same thing in number one or number two. They don't do the work. I ask investors and speculators to limit the number of speculative stocks in their portfolio to the number of hours per month that they're willing to spend studying their portfolios. I've graded thousands of portfolios with more than 50 speculative names in them. And I know that not 1 in 100 of those speculators spends 50 hours per month studying their stocks. And when I say studying their stocks, I don't mean watching Rick Rule videos or reading the Northern Miner. I mean reading quarterly reports, reading resource statements, reading insider filing statements, reading 43101s or pre-feasibility studies or bankable feasibility studies. I mean working. The third thing is that most investors have a time preference, which is unrealistic. Many investors invest around a theme, say uranium, or say silver, or say copper, that likely has a 5-year expected course. Many others speculate on exploration outcomes that might take 18 months to mature. And despite the fact that these investors are investing in identifiable and accurate narratives, they employ very short-term tactics. If you are investing in a 5-year narrative and you have a 3-month time frame, you're almost guaranteed to fail. The greatest part of my financial success, other than risk tolerance and being willing to work, is that I got old. And I came to understand that I needed my time expectation to conform with what was required. I needed to be able to experience compounding. Even on the speculative side, what I learned, and it actually surprised me, is that over 50 years, the speculative stocks that I enjoyed tenfold or more returns on generally required 5 years to enjoy those returns. And in almost every case during that 5 years, the share price in question fell by more than 50% at some point in time in that 5 years. So in addition to being patient, you have to be tenacious. The point of the speech was that we are in a period now where people hate junior resource stocks. We're in a place now where the people who are left in junior resource stocks are fad chasers. They're anti-contrarian. We're in a place now where people's investment strategy is, quote, got a hunch, bet a bunch. They aren't willing to do the work. And we're in a place now where all kinds of people who don't know anything about trading consider themselves to be traders rather than speculators. If you address those 4 things within your own character, there is no sector that I know of that has a better potential risk to reward than the junior miners. Let's start, though, with the headline risk. The sector itself, the whole sector, sucks. Let's get that clear. If you merge every junior miner in the world, there's probably, 2,500, 3,000 of them, into one company. We'll call it Junior Explorco. In a very, very good year, that company, the industry, would only lose $2 billion. They'd only lose $2 billion because they couldn't raise too much more. In a bad year, they could lose $5 or $6 billion. They would call that a good year because they raised that much money. But the point of this, at the beginning of the exercise, is your listeners have to ask themselves how much money they would be prepared to invest in a company that lost $2 billion a year. Would they invest 8 times losses or 12 times losses? In a bull market, would they invest 15 times losses? When they're sick with that number, then they're ready to go. Because a subset of those companies, 5% of the issuers, maybe 10% of the issuers, generate so much value that they add legitimacy and even luster to a sector that loses $2 billion a year. The game then is how to separate the wheat from the chaff. How to know enough that when the stock that you've done work on declines by 30 or 40 or 50% in price without declining in value, that rather than being shaken out and selling at a panic bottom, that you understand that the value is increased and you buy more. That's the game. And the reason that I said to the people in that audience that they had no excuse not to make $1 million or more in 5 years is because they'd taken the first step. They had invested in themselves to come to this conference in Vancouver, the epicenter of junior mining finance, and invest in themselves. For those people who were willing to do the work, who were willing to enter now, this is truly, truly, truly a spectacular time. But it's only a spectacular time if people are willing to examine themselves and examine their reaction to the risks that we just enumerated. Natural gas for a while was free, basically in West Texas. Now that same gas is $350, $375 a million BTU. I think it goes higher, but it's no longer a contrarian activity. What might be a contrarian activity is Canadian natural gas. The Canadian investor seems to be taking Mr. Trump seriously in terms of his tariff discussions, without understanding that the structure of the North American energy market requires Canadian natural gas. And also without understanding that one of the great markets for Canadian natural gas will be in Europe through gas liquefaction. And because of the politics of Canada, Canadian natural gas can't travel to the Atlantic through Canada. Their prime minister believed there wasn't a business case for a commodity in demand. What that means is that U.S. transmission companies, liquefaction companies, natural gas companies, and petrochemical companies will make money transporting Canadian natural gas through U.S. facilities to Europe. Trump is not gonna put a tariff on that thing, particularly given how enthusiastic the oil and gas industry was in supporting him. He's nothing if not transactional. So right now, the specter of UF tariffs is hanging over Canadian natural gas. I think it highly unlikely that tariffs on Canadian oil and gas will become a reality. The commodity that I'm probably most attracted to in a contrarian sense are rare earths. First of all, rare earths aren't rare. We need to get that straight. We haven't found them because we haven't looked for them. And we haven't looked for them because the Chinese produce them so cheaply. Two things there. The Chinese have produced them cheaply, in some measure because the environmental standards employed by the Chinese in the extraction of rare earths have been, it would be charitable to say, lax, devastating. And the Chinese people and even the Chinese government have much less of a sense of humor for the environmental devastation that's occurred in Xinjiang. As a consequence of that, the cost of producing rare earths in China is going higher rapidly. Secondly, rare earths have become to be considered to be geopolitically important. The Chinese have threatened to withhold rare earths from U.S. markets, preferring to ship goods made in China with those components themselves. because it is very likely that the price of rare earths goes up as a consequence of the fact that the cost to produce it will go up, and also because supply chains in Korea, Japan, Europe, the United States, Canada, have decided that there is too much political risk around Chinese rare earths. I suspect that high-quality rare earth deposits in other parts of the world will do very well over the next 5 years. Make no mistake, the biggest ones are only marginally economic at today's rare earth prices. But I think today's rare earth prices are unsustainably low, both for geopolitical purposes, but much more importantly, for environmental purposes. I think that platinum and palladium are good speculations. They're good speculations because most of the world's supply comes from South Africa and Russia, and both of those places are unstable. They're good speculations too because, with some exceptions, probably 75% of the South African platinum industry is unprofitable at today's prices. If you had supply disruption, because the most prevalent use for platinum and palladium are autocatalysts, there's a lot of price elasticity. It takes about $100, $125 worth of platinum to enable a sale of a $50,000 or $60,000 car. If you doubled the price of platinum, it wouldn't change the finished price of the product that the platinum goes into, the car. What that means is that if you had a nationwide strike in South Africa, or if the Russians were prosecuting a war and as a consequence of that couldn't make the sustaining capital investments in their platinum industry, that supply decrease, if any, would have an immediate impact on the market, and the increasing price of the commodity wouldn't impact demand. Is this going to happen? Is this a certainty? Not a certainty at all. Is it a possibility or a probability that's worth speculating on? Absolutely, yes.